Hi, I'm Jeff Silver with Big Valley Mortgage. I'm here with Mike Sandoval with Remax Gold Real Estate, and Jeff Lendl is with Goosehead Insurance. Welcome.
Thank you.
What's going on, Jeff?
Just figured we'd sit down and chat about insurance. Let's get right into it because I'm just curious. There's a lot of people out there that are kind of wondering what in the heck has gone on in the insurance industry. And so if you can maybe do a little comparison, maybe 3 or 4 years back, and then bring us forward to today, that'd be awesome.
Yeah, definitely. So insurance industry 3-4 years ago, specifically in California, took a huge dive. I mean, it was like from what I know, it's the worst that we've ever seen. And so carriers left like crazy, lots of politics going on, trying to get them back, and now finally 3-4 years later, coming up to now, we see a ton of carriers coming back in. Rate increases have gone up, but that's to be expected. Inflation's gone up a lot. So everybody's really excited about that. And, being a broker myself, I get to see a lot of, the inside of all of these companies and, territories and new zip codes that are opening up. A big concern is fire in California. That was huge, and so it's like that was all of those areas were the first areas for carriers to say bye-bye to. Looking a lot more positive now. We're still wanting to see more open up, kind of like it was, 4 or 5 years ago. It was a great industry at that point. We're still kind of in the weights, but things are in a positive direction now.
Well, would you say that I'm just going to jump, the elephant in the room. Everybody talks about the California Fair Plan.
Yes.
And I'm not sure everybody knows exactly what it is. So can you explain to people what the California Fair Plan is, what it's made up of?
Yeah, definitely. So Cal Fair Plan, in general, I would say people think that it is a state-run program, and that's, it's just the worst thing to be with, right? That's maybe half true in the sense of, it's not necessarily the option you want to be with because they're crazy expensive, but it's not anything state-related at all. What it is, it's actually a pool of all of the insurance companies that are in California. They come together and then they have to pay into it every single year because it is the backup plan, in a ton of areas in California now. I feel like half of California is now zoned as high fire. And so now we're kind of working backwards. Carriers are opening up and, taking a few small zip codes out of those areas, which is great. But yeah, it's a pool of carriers and they all pay into it based on their saturation and percentage that they have in California.
Okay. So like if State Farm, let's say, is insuring 30% of all the policies in the city of Roseville, then they would need to put 30% of a number into the pot for that area.
Yeah. So actually, to be more specific, I think State Farm, I think this is last year's information, but State Farm, that's a great example. I think they're actually 40% of California. So they were, amount. Oh my gosh, it's massive compared to the rest of the carriers out there. And so it's more of an in general. It's not like per city per se, but it's in general, like all of California. And that's what they have to pay in this pool that we all call the Cal Fair Plan.
So what you say is if you can't get fire insurance, this would be the plan that you would get. Does that cover like personal items too, or is it just strictly the structure, or what does it cover?
Yeah, so it covers pretty much everything if the peril is named fire. Like, sure, there's wind and vandalism. There's a couple other small items on there that the Cal Fair Plan does cover, but everybody calls the Cal Fair Plan, it's a fire policy. Like, that's why the rates are so crazy high. And when you're getting into these, these areas, LA areas or even North California, basically, when people come to me, it's funny. I'm like, okay, look up the address, zoom out on Google, and if you see green surrounding your property within a 50-mile radius, you're going to be with the Cal Fair Plan. Right. Like, there's no carrier in California that's going to take it. It would be very rare, right? And so it's a 95, 99% chance you're going to be Cal Fair Plan all day long. But yeah, with the Cal Fair plan, you do have to have, it's called a DIC policy, difference in conditions. And so that is, people call it's a supplemental policy, a wraparound policy. And that's where you get your liability, your water claims, falling objects. There's everything else but fire and the small other items that Cal Fair plan covers.
Is there a website you could look up to see if that house falls under like regular insurance, or how do we how do we find more information on, let's say, if, like you said, if it's by some green or whatnot? I mean, is there a website? Or?
Not that I know of website wise, but honestly, the best would be to get in touch with an insurance broker, kind of have them in your back pocket, especially, if you're in the industry, if you're a lender, or, a loan officer, real estate agent, definitely have a broker because, depending on how great they are, if you could just text them an address, be like, hey, Jeff, what is this looking like? Do you have any carriers that are accepting this risk? And the turnaround it's all, it's same day. It's not hard to find that. You run it through the system and you see who's going to take it, who's not. And if it's going to be Cal Fair plan, here's your soft rate. Most likely that's what it's going to be like. Anywhere from $5,000 to $10,000 is a really good average with Cal Fair plan yearly. And then you add the DIC on top of that.
Well, that's a much easier way than what I remember when it first began, which was you had no idea if it was the Cal Fair plan, and you also didn't know how much it was going to cost until you were in contract, got a regular policy that was denied, or were unable to get a policy, and then you had to apply to Cal Fair plan to get a number. All that, and now all we have to do is make a phone call.
Yeah, or a text message. I mean, really. I mean, nowadays it's super quick. You don't even have to get on the phone. Shoot an email.
Morse code, maybe smoke signals.
Yeah,
Jeff.
Yeah, exactly. No,
That's awesome.
It's good stuff. And I mean, having that broker in your back pocket as a client, as a real estate agent, as a loan officer, it really helps with DTI ratio and actually seeing if clients nowadays with the rates, do they qualify, right? Like fire coverage, if you're wanting, this beautiful rural property or a secondary cabin for the family, you got to know this stuff before you get into contract on this house, before you even, submit an offer technically.
Yeah, it's actually one of the contingencies now.
Oh yeah.
So, you have loan contingency, appraisal contingency, inspection contingency, and you also now have insurance contingency on the contract saying that I will have this removed within a specified, right?
Absolutely correct. And sometimes we see in the contract that that contingency sometimes is longer than a, say your home inspection or your general home contingency as well. So yeah, we're seeing those names, those numbers differ or days on that specific contingency, Jeff. Yeah, that's right.
Yeah. That makes a lot of sense.
What challenges are you seeing in the industry today, other than of course, California Fair Plan? Is there anything else that you see? Things that are changing. What's your thought?
Not much other than what I already spoke about. Big thing is fire. What the insurance policies are going to cost. On average, I mean, this is so crazy. Like 4 or 5 years ago, when there was a beautiful California insurance industry, I mean, we were writing tract homes for, $400, $500, $600, $700 for the year. And it's like, it's almost non-existent. You can get that rate on a brand new house with a competitive carrier. And maybe if you bundle, get the multi-policy discount or something, but on average, a normal home, 20 plus years old, I mean, we're looking minimum $1,500 to $2,500 for the year. So that's a major increase. And people don't understand also, here in California, believe it or not, we've been spoiled with insurance rates. We were actually one of the lowest costing insurance states in the United States. Nobody knows that. And so now, we're getting up into that mid-range, a bit more realistic. You look at Texas, you look at Florida. I mean, they've got hurricane on top of their policies and stuff, or a separate policy just for that. And I mean, everybody expects $5,000 a year minimum. And so it's it's kind of bringing people up to today's standards and normalizing the market. It is a lot more expensive, but at least we have carriers coming back.
Yeah, I remember $10 a gallon of gas in Europe. People talking about that, which is why they went to tiny cars. And then we were always saying, well, there's no way we're going to even get close to that. And we've gotten close to that by getting halfway, almost 3/4 of the way there.
Right.
In California for sure. But I'm just curious if somebody has a policy and, the worst case scenario, meaning that now they need to collect on that policy. So the fire happens. Let's just say the house does burn. We'll just use this example first. The house burns to the ground and they need a complete rebuild. Are they going to be able to rebuild that house completely at today's cost for construction? Or is there something they need to make sure is in their policy up front so that if that does happen, they're able to do that?
Great question.
Yeah, great question. So will somebody have enough coverage on their policy in, a catastrophic loss scenario where the house burns to the ground? Maybe, hopefully, and I say that because most people don't want to touch their insurance. They don't like dealing with it. This is very typical with people. They don't want to shop it out. They don't want to take the time. They don't even know what the coverages mean, right? So again, you need to have that advisor, the insurance advisor, or broker, in your pocket who can actually explain all that stuff to you. But a couple of items, that I would do is, you need to have that reviewed. I mean, if you haven't had your home insurance, any of your policies reviewed within 3 years, that's a bad thing, because in 3 years, reconstruction cost, on your policy, taking your example, it's labor and material cost. That's it. So again, we're not talking about the value of your home, right? If you're in San Francisco, it's going to cost, $400 plus a square foot, but your house is much more than that in value, right? So we're just talking reconstruction cost. And again, building materials, labor, that's all it is. And so you need to have somebody at least updating that, rewriting your policy with the current coverage standards, something, an endorsement that typically I would say comes on most policies that I would double check is on there. It's called extended dwelling replacement cost. So typically that comes at a standard of an additional 25% on top of what your coverage is just for the dwelling. So that kind of gives, the person doing your claim an option like, hey, if my policy is going to pay out $500,000 as an even example for your house that burned to the ground, and let's say you don't have enough coverage. Well, if you have that extended dwelling replacement cost, they get to approve up to an additional 25% on top of that to help rebuild your home, right?
And on average, what would that cost?
Oh my gosh, it's so minimal. Like it depends on the carrier. And again, like as a broker, every carrier is so different. They could charge you $20 for the year, or we could be talking, a couple $100.
Yeah,
for
but still,
this
I guess it would depend on the house, I'd imagine, how big it is.
Exactly.
Yeah. Oh my gosh. That almost sounds like a no-brainer.
Yeah,
right.
It's kind of like, if you don't touch your insurance for like 3 to 5 years, you might be able to hope that you have that endorsement on there and like, okay, it'll kick in if necessary.
Right.
But honestly, like you need to have your dwelling coverage proper, and that's coverage A. Like that is the most basic coverage on every home insurance policy out there. It needs to be at the standard each.
So isn't that what insurance is all about? To get rid of the hope?
Yes.
I hope this doesn't happen.
Oh yeah.
Now I'm insured. I don't need to worry about this
totally
happening.
Exactly.
Yeah,
Exactly.
Interesting.
Yeah.
So I heard something recently with the Malibu fires and whatnot, and I didn't know about this until I heard about it, and I, talked to my insurance agent, you as well. If you have a living trust, and if the house is recorded in a living trust, however, you haven't informed your insurance it's in a living trust, they may reject the claim, which I immediately, obviously I have a trust, obviously. So can you expand on that?
Yeah. Oh my gosh. That's a big thing. People nowadays we're seeing a lot more trusts as the named insured on the policy versus the person, which is great. But the thing is, some people, have a trust, put their house in the trust now, and then they don't touch their insurance policy. And so it's 100% correct. It's the craziest thing, because when you think about it, you're like, well, I'm the contact on this policy and the address is correct. Why aren't you paying out on my policy? Well, let's be honest. Insurance companies, they will try and find a way to not pay your claim any way possible. If there's a little gap or something, they will find it, and then they will deny the claim. And then that's not very fun. So yes, if you're
stunned,
it's crazy. If your house is in the name of a trust, or if it's in an LLC, for example, the policy has to follow the title of the home, and
Right.
so that's just where it is.
Huh. Well, that's interesting. And now I understand why underwriters will say we're not going to fund this until we see the policy, the binder, show exactly as we have it on the mortgage. But we can now fund loans in trusts. So now what you're saying is the policy that we have or the borrower has on the house. Now, if we're funding in a trust, it needs to show the trust on the policy. Does it need to show the trust like Silver Family Trust and then Jeff Silver and Linda Silver? Does it need to show that?
Each carrier does it a bit differently, but as long as the trust is listed as an insured item on the policy, if not being the main insured, that's basically what they're looking for.
Like an additional insured.
Correct.
Okay, gotcha. Yeah.
Oh, okay. So an additional insured.
Yes. So
Interesting.
you could get an amendment. So if you don't have it now, I would imagine you could then call Jeff, and then he could call the insurance company and then add your trust onto as an additional insured. You have to modify much. Correct?
Exactly.
Oh, yeah. Believe me, my wife and I have something to talk about tonight.
Oh, yeah.
That's how we do these things, right?
Oh, yeah.
That's why we got the
I mean,
expert,
that's kind of scary.
Yeah.
Honestly, I mean, I can't even imagine, especially from a lender point of view, if the people put their house in the trust after the loan is done,
Yeah.
and yet they don't put the insurance on with the trust, and the house burns down. Well, no, because it would still be insured. The additional insured, which
Only if
is
you've
the
done it.
mortgage company.
Oh.
Yeah.
The mortgage company would be paid back what they owe, what the borrower owes, but yet they wouldn't rebuild the house. Is that how that would
basically
work?
if at the time of the loss, that's all insurance companies care about, right? So the date and the time of the loss, if the house is recorded in a trust and the policy was not endorsed or issued with that trust on there, then your policy's been invalid that entire time.
So I would assume that a lender who has the loan, the house is the collateral for the loan, wouldn't they want to make sure that people then make that change?
From a lender's perspective, a lot of times I feel like I'm not 100% sure. I feel like that's more of a maybe you question, but I think what they're looking for is when they close the loan. They want all the buttons to be dialed up at the close of the loan. Whatever happens after the fact, obviously that's a different story. They're not going to follow up. But
Well, that's kind of what I'm talking about. I'm saying, okay, it happens after the fact. So during the loan or at the loan closing, the person is put on the policy exactly the way it needs to be. Mm-hmm. A year later, that person gets a family trust and puts the house in the family trust,
Right.
but doesn't put the insurance, change the insurance
Right.
on it. The lender is still the also insured on that. So would the insurance company pay the lender? In other words, is the lender still secure?
That's a good lender.
that's a good question because they
Yeah.
don't
That
get,
is.
they don't
Yeah.
automatically get notified of a policy change. So when a
Right.
lender's listed on there, they get notified if the policy gets canceled, right?
Right.
But other than that, I don't think there's anybody that goes out of their way to click the special button to
Right.
be like, hey, notify the lender.
I mean, that's kind of scary, actually.
Oh, yeah.
This is food for thought. Maybe a podcast for another time.
Yeah.
Because I am absolutely going to do some research on this.
Well, when I heard about it in the whole Malibu thing, these guys had these multi-million-dollar properties,
Oh, yeah.
and they had them in trust, but they didn't have it recorded. And when I heard that, I immediately called and I said, "Hey, is this true?" And they're like, "Yes." And then I immediately said, "Okay, change all the policies because I had them at that point in the trust and whatnot." So yeah,
Wow.
Smart.
it's an eye opener.
Yeah, just to kind of go back on what you were talking about, the way things were as far as costs. Because as a loan officer, I have to do an estimated cost for people so that they know or have an idea approximately what everything's going to be, and their payment is made up of PITIMI, which is principal, interest, taxes, and insurance, as well as mortgage insurance if they need that. So the I part, the insurance part, I always used to just on an average house, say $400,000, I put $60 in there. $70 a month. Now I'm doing 125
good.
or $150 a month.
Yeah, good.
I mean, that's double 2.5 times. That's crazy.
I know.
But
It
now
is
we're
crazy.
normal, right? Now we're
Correct.
like
Yeah,
everybody else in the country.
We're getting there. I mean, people are having a
Wow.
hard time getting used to it, but yes.
I get it.
Good info. Awesome. Other challenges that you see other in the market? Is there a time where a person was not be able to get insured because they have too many claims? Something like that. I know that there's a program called LexisNexis, something like that, where you could do some background. Insurance companies look you up, see how many claims you've had. Have you run into any of that?
Yeah, that's not too big of a concern. Sometimes you'll run by a client that's got 3 to 5 claims within the past 5 years. The 5 years a threshold, and so in general, that's actually a great question, because a lot of people think when I buy insurance, if anything happens, I'm just going to call the insurance company and they're going to take care of it. I'll pay my small little deductible that I set up properly just in case these things happen. But what happens is, especially in this industry, I mean, we're getting better, but in the past 3 years, you could submit a claim and then you're going to be non-renewed the next year, because now you're a higher risk, because you are somebody who's willing to make a claim in general, even if something happens, right? Big or small. And so, as an insurance broker or, somebody who's licensed, you can never advise or tell somebody not to make a claim. But if people give me, the hypothetical, like, what would you do, Jeff? I always tell them, I'm like, if I'm going to submit a claim, it needs to be worth it, right? You got to be careful, because these insurance companies, again, they're not on your side. Like, I mean, it is what it is. Everybody knows this. And, as long as your policy's set up, you're going to get paid out properly. It's going to be great. But when you submit claims, they hurt you. They stay on your record for 5 years. And depending on how big they are, or even if it's a catastrophic loss, or if it's a water claim. Water claims are terrible. Insurance carriers don't like them. And so, carriers are more accepting nowadays of, one claim on record, depending on how big it is. But if you start talking anything 1+, like you're probably going to be toast, and it's really hard to find insurance for those people. And the rates are crazy.
I have a great story about that. It's not a great story, but it's a story. So back, I think 2021, I had a tenant that was leaving one of my rental properties, moving out. He had his U-Haul backed in the driveway, right? Loaded up his stuff, and we swapped out keys, everything. I said, 30 minutes later, I get a call. I say, hey, Mike, I need you to come to the house. I said, why? He goes, I accidentally backed the U-Haul into the garage. And I thought to myself, oh, maybe he dented the garage door or something like that. No, Jeff. He literally backed the big U-Haul into the structure of the garage and messed up. Obviously, went halfway in, and it was literally, the garage was now tilted. It was obviously structural.
Gosh.
Yeah, and so it wasn't my fault. It was him. He didn't have insurance. He rented the U-Haul, didn't have you could pay extra insurance, so he was on the hook for that. And unfortunately, I got stuck holding the bill, so I had to put in a claim under my landlord policy. They fixed it, all of that. It cost me my deductible. The year later, I got rejected. I couldn't get, they didn't auto renew me, and there was only one company that was able to do that. To renew me, and the premium wasn't pretty, so It wasn't my fault. I didn't do it. And
that's crazy.
That is unfortunate. And then, kind of to piggyback on that, I had a person that was trying to buy a house, and the lady that was selling the house actually had a $2,500 claim on a fence. The fence blew down, and so for just $2,500. And so a lot of insurance companies wouldn't insure the new buyer for that house. I thought that is crazy because
that's crazy. It kind of, and again, that's a very specific item. If the claim is with another person, then there are a lot of carriers that will completely bypass that. They'll pretend it's not even there unless it's something structural with the house, or maybe it wasn't repaired properly. Like, the big things like that. A fence, I mean, again, fence claims in general, I would never ever submit a fence claim. Just putting that out there.
There you go.
It's out there.
It is out there.
Like, these, when your dishwasher leaks and there's water on the floor and it, kind of damages some of the cabinets on the bottom, I would never submit that. I mean, everybody has a different threshold. If it's 10,000 plus, okay, let's start thinking about submitting a claim. It's all, everybody's financial situation is different. So if you can self-insure up to $5,000, great. You're going to save yourself a lot of headache, with insurance, especially in this industry while we're trying to reboot. But, maybe your threshold is 2,000, who knows, but you're going to have repercussions, unfortunately, for putting claims in regardless.
So the top three, big no-nos that insurance company hates, obviously you mentioned water damage. What would you say the top three would be, Jeff?
Yeah, so the big thing that's very rare to see is liability claims. So that's, if somebody sues you or if somebody gets hurt on your property, maybe a tree on your property falls on somebody else's house, like, oh my gosh, that's a liability claim that you have to put in on your insurance policy. And carriers, I don't think there's many carriers that will actually accept a liability claim because they're so significant. That's one of the biggest coverages on insurance policies. Typically $500,000 is the highest threshold. So that's a big one. Water claims, they get a little hairy. And then obviously fire is another big one. Theft, right? Theft is a bit more acceptable, but again, it depends on the dollar amount. So that's a big thing with insurance companies. And theft is a little sticky because it's one of those things, the insurance company has to take your word for it unless you have proof. So a great one, your wedding ring, your wife's wedding ring. If you have that endorsed on the policy or added in any way, and you're going to submit a claim and say, oh, somebody took it off the counter when she was at a restaurant in the bathroom and we went back in there and it wasn't there. And it's a $20,000 ring. That's huge fraud. Like there's a lot of fraud cases, if people try to lie about that, and then it's like, is the insurance company going to accept that or not? A lot of times, no, you got to have some type of proof to a degree. And, but when you submit that claim and you get the payout, yeah, good luck finding another insurance company.
Wow.
That's a scary, gosh, I never thought about that.
Even though you specifically had that put on the policy, to make the claim, it's almost like, what's the point?
Well, yeah,
because if I don't specifically put that on the policy, and then let's say it actually does occur, now it's my decision to make. Yes, it was a $20,000 ring. Does an insurance company say no, it needed to be on the policy?
Yeah, so with jewelry, so there's specific categories, subcategories of personal property that you have to be added on. It's called being scheduled on the policy. So like firearms, cash, paper money, jewelry, like these are, antiques. These are all huge. I mean, these could be, 6 figures, significant in value. And if you expect your policy to pay out on one item of that value, they're not going to do it. You have to schedule it on there, which is going to cost a little bit more. Nothing crazy, $100, couple hundred for the year, but it's worth it.
Okay.
Like a wedding ring. Totally. People don't realize you can actually add that to your home insurance policy, and it's great.
I have one more question. Sorry, I didn't mean to cut you off. I know you got to get going, but one last question, and that is this. Would it be a good idea for somebody to take their cell phone and video their house, showing and documenting both with video and verbal while going through the house that this is an antique table, and go right through the house, go to the jewelry box and say, this is the jewelry that I have. Here's all my firearms. And is that a good idea?
100%. I think that helps with personal property in general, and I actually have advised that throughout my career to people. It's like I tell them, I'm like, hey, every 2 or 3 years, it's kind of weird, but walk around, open your cabinets, open up everything, look at your furniture, put your toothbrush in the video. Like seriously, every item that you own, just do a quick little 2-minute, 3-minute, 5-minute video of everything that's in your house, because that does help the insurance company when there's a payout. But honestly, it helps you more, right? Because if your house burns down, are you really going to remember every tiny little? No, you're not. Like,
Right.
you think
No.
you are. You're
Yeah.
going to remember the big ticket items,
Yeah.
but you're not going to remember all those finite things that you would prefer not to be without, right? And if you can replace them, go out and buy them again, then you're going to be able to. But regarding the high ticket items in those subcategories, you're still going to have to schedule those on the policy to have coverage. And then that ring scenario, it's always great to have some proof, right? So again, you're not going to catch somebody on video stealing your wife's wedding ring. I mean, most likely not. But any type of steps that you can take to get proof in any theft scenario, totally worth it.
Are cars covered in the garage if the house burns down, or is that auto policy?
No, great question. Anything auto related is going to be on your auto policy. That's a comprehensive.
Oh, is that covered if your house burns down and the car catches fire or no?
Yeah.
Oh,
Yeah.
it is?
So not on the home insurance policy, on your auto policy.
Okay, got it.
So comprehensive is water, fire, damage, all that fun stuff.
See, I thought if my golf clubs were in my car and those got stolen out of my car, that's my homeowner's insurance.
It is.
Oh.
The golf clubs are.
Okay, so not the car
that's
itself, but
Correct.
everything in the car.
Exactly.
Oh.
So personal property that you own,
All right.
that's not going to be on your auto policy. Yeah.
Good to know.
Yeah,
Nice.
totally.
Yeah, absolutely.
So this was great.
Yeah,
I mean,
well,
awesome
wealth of
information.
knowledge, Jeff. Thank you for your time.
Yeah, no
Definitely
doubt
always.
about it.
Yeah,
Thanks
it
a
was
lot,
great.
Jeff. Appreciate it. You guys have a great day.